you had an expensive phone and it broke, whether you dropped it or something just kind of stopped functioning on it for one reason or another, your option was pay substantially out of pocket or continue to use a broken device. So we saw an opportunity within the market that we could provide that service at a quick turnaround.
There's a certain common theme, sales and service, and that kind of flow throughout businesses and industries. But so why landscaping then at that point?
We saw a gap. And the gap at that time period was in the landscaping industry, you had your kind of residential landscapers that would come and mow like just somebody's house, right? And then you had only a handful of truly high scale commercial landscapings that would perform other schools, businesses, government facilities, whatever. There was an extremely small number of those that were doing it, and all of them were charging substantially much more.
Joe Carter. Joe's the founder of Twin Flame Group Texas, a strategic growth advisor, and a no BS mentor for founders stuck between hustle and scale, which I'm sure there are a lot of them.
What gets me excited to go work with my clients every single day is I get the capability to actually fulfill what I want my legacy to be.
Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with Joe Carter. Joe's the founder of Twin Flame Group Texas, a strategic growth advisor, and a no BS mentor for founders stuck between hustle and scale, which I'm sure there are a lot of them. Joe, thanks for coming on the show today. I appreciate you taking the time. I'm really excited for the conversation, so thank you for being here.
Of course. Thank you, Jason, for having me on. I've been looking to this one for a while simply because know your why is quite literally one of the things that I say to myself every day. So I can't wait to jump into this.
There you go. Well, I'm glad. I'm glad that it's meaningful to you as well. So, why don't we start with your background? Tell us a little bit about yourself, kind of what got you to where you are today, and then we'll just have a conversation from there.
Sounds like a plan. So I spent a little over a decade in kind of your traditional corporate environment, climbing the ladder, moving up with several different Fortune 100 companies. And I kind of got to a place where truthfully I was burnt out, working 80, 90, 100-hour work weeks nationwide, never really taking a day off, didn't even know what a vacation was there for a while, and really kind of got sick of, for lack of a better way to put it, but no BS, making other people rich. So I wanted to create something of my own. So I had the opportunity and dove headfirst into a business and an entrepreneur opportunity, was able to scale that fairly quickly in about a 3.5-year timeline. We went from nothing, zero, to we had 12 retail locations, 10 mobile vans performing electronics repair throughout the Dallas-Fort Worth metro, and had no intention of selling, however, was approached by a franchisor to buy us out because they wanted to make that market their corporate kind of training environment, so to speak. So through negotiations and due diligence, was able to sell that one off and walk away with a very strong profit. Again, didn't want to jump back in to the corporate world, so dove back in a second go around into entrepreneurship, completely different industry, landscaping this go around, and was able to scale it nationwide in roughly the same time period, and ultimately sold that one to a private equity firm. I got to stay on with that PE firm and ran due diligence for them as they evaluated other businesses to potentially acquire, and saw kind of firsthand the buyer's perspective. So I had sat in the seller's seat a couple of times. Now I got to sit in the buyer's seat through roughly $14 billion worth of business evaluation and business deals. And I figured out several things that I wish I had known through those previous sales that I probably would have made a little bit more. And an aha moment created itself as my contract was ending with that particular PE firm of like, I wish I would have known all this stuff years ago and probably would have exited substantially better had I known that. Why not just help others be able to navigate through that same process? So that's ultimately the kind of origin story, if you will, of the Twin Flame Group, is we want to be able to take all that experience, corporate, starting multiple businesses, able to successfully exit, as well as a private equity buyer's lens, and put it together to help founders go from stuck to scale and from scale to exit.
Yeah, love it. Congratulations on that success and basically, two starting from zero businesses and growing them to successful exits. So I definitely want to kind of probably spend the bulk of our time on what you mentioned, some of those things that would have helped you along the way. But I wanted to just dive into your story a little bit more first, and just
Sure.
that. So electronics repair, that one was Dallas Fort Worth. I mean, what, why there? What, or why that industry? I guess, and then kind of I can understand maybe the scalability of that, but talk to us a little bit about that business itself, and then I want to kind of do the same thing with the landscaping business. I
Sure.
basically want the listeners to understand like maybe why you chose those industries and where your head was at
100%.
then, so that we can use that information, moving forward.
Yeah, 100%. So the electronics repair was, this was a while ago. It was the first business, but at that time period, we're talking like 2007, 2008 timeline. Electronics, specifically cell phones, were going through a pretty strong pivot. Phones themselves were exceptionally expensive at the time, similar to today, but the main differentiation between then and now is you couldn't walk into AT&T, Verizon, T-Mobile, wherever, and get a new phone for free. That was not an option at that time period. So if you had an expensive phone and it broke, whether you dropped it or something just kind of stopped functioning on it for one reason or another, your option was pay substantially out of pocket or continue to use a broken device. So we saw an opportunity within the market that we could provide that service at a quick turnaround. So we were able to do phone repairs in under 2 hours. So you give me your device, if it has a broken screen, it's got a new screen on it 2 hours later. Because like it or not, then and now, people live with their phones and they don't want to be without it for very long. That was just one of many. We fixed everything electronics, but that was one of the main reasons why we selected that particular industry, was because we saw a humongous gap between what the demand potentially was. And obviously, I think we chose correctly based on our exit strategy, but something that we could provide a convenience level to our customers or consumers. So that was one of the main whys behind it, was just that kind of that gap in the industry, if you will, at that time period.
Okay, great. And then why the switch to landscaping? Just they're service businesses, right? Ultimately, so it's
Mm-hmm.
I think sometimes we like to separate industries very specifically, but I think a lot of times when it comes down to service, there's a certain common themes, sales and service, and that kind of flow throughout businesses and industries. But so why landscaping then at that point?
100%. Yeah. So the landscaping was a similar methodology in terms of looking at a variety of different industries and picking the one that we thought, and I say we because it was myself and a couple other people inside of our investor group that originally bought in and created that. But we saw a gap. And the gap at that time period was in the landscaping industry, you had your kind of residential landscapers that would come and mow like just somebody's house, right?
Yeah.
And then you had only a handful of truly high scale commercial landscapings that would perform other schools, businesses, government facilities, whatever. There was an extremely small number of those that were doing it, and all of them were charging substantially much more.
Mm-hmm.
So we saw a gap in terms of we can provide residential grade opportunity and residential grade price to a emerging piece of the industry within the landscaping space, which was kind of that commercialism, especially in the Dallas-Fort Worth metro, which is where we launched. There was a significant amount of businesses moving into Texas for a variety of different reasons at the time, and we saw that scaling for several years. And obviously, we chose correctly, and the Dallas-Fort Worth exploded very quickly, that we were able to reinvest multiple times over into Denver, Arizona, Florida, a couple other nationwide particular locations that we saw a very similar opportunity in terms of there was this missing piece of a commercialism that was occurring within the landscaping space that we thought we could go in and, I don't want to say undercut, but that is kind of the better way to put it, undercut the small amount of competition that was there, still be able to drive substantial margins and get recurring revenue. That was ultimately the big why behind the landscaping thing, was it was a heavy on recurring revenue, and that is something that just obviously helps with cash flow, it helps with profitability, and ultimately it helps with exitability as well.
Yeah. In that instance, I hear you say that you acquired the first landscaping company and then kind of grew from there, or you didn't start that from scratch. Would remind me
So we
of when.
did buy out kind of a smaller, like mom and pop type thing
Yeah.
within the Dallas market. So it was strictly residential, not strictly, it had about 95% residential to commercial customers. But there was a humongous opportunity for the commercial aspect within that particular marketplace. So we turned it from 95% at the time to within 18 months, that number was 68% commercial to 40, or excuse me, 32% residential. So we were able to completely flip it around. Commercial, it's substantially higher price point, much more recurring, and you have the capability to get very easy traction in terms of referral. Well, we just did the school across the street. Can we go ahead and do your office? We're here, we're local, we're right across the way. We can get it done on this particular day. And we were able to scale it very, very quickly. So it was a small acquisition that we basically turned into a startup as a result of that. And then we followed that similar methodology as we went into new markets. We wanted to find a smaller kind of mom and pop that we could buy for a fairly good price, have a very small clientele to start with, and then be able to apply our commercial model behind it and help it scale very quickly.
Yeah, that makes sense. And you actually answered my next question, was just that you found that, take that same system and plug it in other locations, and find someone who's existing and take their, whether it's their brand or their just local presence, and then build from there. So, I mean, two successful exits, but you then sort of reached the conclusion that there are things that you could have done better to have even more successful exits. So let's talk about that now a little bit, kind of the driver behind what you're doing at this point. How do you, when you look back at those scenarios, I mean, what are some of those things that you think you would have done differently or better, or what, I think, I'm sure everybody likes the cheat code and wants to sort of skip the hard work, but I do think there's something to be learned from someone else's journey there, and kind of figure out how can we take those same lessons. So how maybe give us a few of those high level things that you think would have directly impacted your ability to, I don't know, and you tell me, scale faster, be bigger, sell for more, like whatever that focus would be.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Yeah, definitely. So, hindsight's always 20/20. You always learn more as a result of going through any process. And so if I look at the first company, the electronics repair, what I know now, what I wish I would have done differently within that one is really focused a lot more on the recurring revenue side. It was extremely transactional. You break your phone, you walk in, we fix it, right? There was not a ton of recurring revenue that was built into that model. And then secondarily was what I call now transferability. I was literally the person that was running all of those. It was me. I was the leadership hat. I made all the decisions, made all the hires, made all the fires, did majority of the onboarding and the training as we brought new technicians into the fold so they knew how to repair all those devices. So when it was time to exit and me leave, someone else had to figure out how to do all of those things because there was not a humongous amount of clarity, documentation, which ultimately translates to accountability and scale. So I really wish I would have kind of thought through that process much, much better. Again, I had no anticipation of exiting that particular business. So just having a slightly different mindset likely would have given me that capability. I applied that to the next company, certainly, as I focused more on recurring revenue. So that one was kind of an automatic, like, aha, let's apply that learning to the next. But in terms of the next one, what did I learn there that I wish I knew today was really the ability for systemization. And when I say systemization, your mind can go in a variety of different ways. But ultimately, can someone who has absolutely zero knowledge of the industry, the service, the performance of their team, be able to walk in 60 minutes or less, be able to digest the entire playbook and go execute it within 80% of your capability? If that's not true, then it's not to a place of systemization. So that's training, that's onboarding, that's playbooks, that's documentation, that's a cadence of your leadership. Like all of those things are just cogs in the wheel of creating something that is systemized. When it's systemized, you can step away and the business does not fall apart. In both those instances, if I took a day off or I took a vacation, when I came back, the business was slightly worse than when I left every single time. Yeah. So how do I do that today is I've taken vacations. I took last week off for the holiday. My business went up because I've systemized everything. My team knows exactly what to do in every potential scenario. They have the autonomy to be able to make decisions and then just follow up with me after the fact, because we have an accountability and a leadership cadence in place that if they miss something or they made the wrong decision, the decision's already made. We can learn from it and apply it to the next one. But ultimately, Joe is not the person that has to push every button or pull every lever. So those are really the things that I would have taken away in both of those instances.
Yeah. I mean, that makes a lot of sense. I'm curious what you think about this. Just, we look at business acquisitions. It's something that I'm very interested in. There's a lot of talk, podcasts, social media, all that stuff. Everybody talks about that recurring revenue piece. Do you think every business can have a recurring revenue component? Like, because I feel like there's certain businesses, industries that lend themselves very well to that, and then others that it's almost harder to like when you talk about landscaping, I can immediately picture like where that recurring revenue comes from. We have someone who comes to our house and I pay him every whatever. So, but the fixing cell phones, where maybe you can tell me, like, in my mind, I don't see a place for recurring revenue to be in that business. And you said in hindsight, I would have made more. So do you, I mean, you must actively go looking for where those opportunities can be inserted, even in the businesses that maybe it's not, and maybe it's just not obvious to me. So I'll stop talking and let you answer the question.
No, it's a great question. And in my opinion, I have yet to come across an industry in which some level of recurring revenue could not be applied. And one of them, similar to what you brought up, that people have a difficulty understanding, is retail. Retail is traditionally a heavy transactional based thing. You walk into a retail store, you walked into it for a reason. Maybe you buy extra stuff while you're there, but you walked into it for a reason. And traditionally, if they did their job, you walk out with what you walked in for. Maybe a little bit more, but you walked in for what walked in and walked out with what you intended to get. But There's no incentive necessarily, or at least inherently built in, for you to come back the next day. However, if you look at a lot of retail centers today, they are applying very similar recurring revenue drivers today. So they're giving you a coupon to come back within a specific time period and save $10. Or they have some kind of membership level thing where you can save 10%. Or they have a delivery service that will provide a slight discount to whatever the service offering may be that you are normally walking into the retail facility to buy. So it's thinking outside of the box in a lot of ways, but I've yet to locate an industry in which you could not apply some level of recurring revenue to it. You might have to get creative and certainly pull on your sales and your marketing hat, especially if you're going to go to a slightly different clientele. But like, for example, the electronics repair, traditionally, especially at that time period, it was individual consumers. You broke your phone, you walked in, I fixed your phone. The recurring revenue model that I would have applied today in hindsight is going after businesses. Businesses have tech. They have tablets, they have cell phones, they have computers, whatever. If I go after those and provide them with a monthly recurring service to oversee any and all tech that they may have and have a discount provided to them for any repairs that may occur, their tech's on the field, they drop their iPad and crack the screen, they're going to pay half of what a consumer will walk in because they have my membership model, but I'm also going to provide them cybersecurity or some other thing that then creates a recurring revenue stream. So it's just applying some creativity to it. But you have to understand who your customer is today and who your customer could be tomorrow and be able to bridge that gap.
Yeah, no, that's a great explanation. Thank you. The other things you mentioned, transferability and systemization. I guess, can you tell me what, maybe, is there a difference between those two things? Like how do you, I mean, I know there's a difference, but ultimately the goal of both of those things, if I'm understanding correctly, is to kind of extract yourself from the business so you can have those vacations and things don't get worse when you're gone, right? Is that kind of where you're going with, and maybe the transferability is the part that I would ask for more explanation on, but yeah, just maybe tell me a little bit about those components.
Yeah, so and everybody might have a slightly different answer to what does transferability mean to you, but in terms of my perception or my viewpoint, transferability is quite literally what you said. If you disappear tomorrow for 90 days, what happens to your business? If it's anything less than nothing, you're not fully transferable. And any high-level private equity firm, VC capital firm, something to that effect, is going to look at that. If Jason has to be there in order for XYZ to occur, I have to replace Jason if I'm buying Jason's company, right? So what is XYZ? What's the components of those things? What do I have to create as the new investor in order to structurize that and give it the capability to scale? Because if I am a PE firm or something to that effect, likely, if I'm interested in buying your business, it's not just because I only want to buy your business. I want to buy 10 other ones that are very similar to yours and apply a similar model and be able to scale nationwide or at least into multiple markets very quickly. So what can I take from your company and apply to the other 9? And what can I take from those other 9 and apply to you? If you already have all those answers, the PE firm, the VC firm, whatever, is going to pay more because they know that they can extract that information from you and apply it to the other companies. So the PE firm that I was able to work with, that's quite literally how we evaluated business. One of the criteria was owner reliability. Mm-hmm. So, or owner dependency is the way that I've rephrased it since then. But how dependent is the business on the owner, the founder, the executive, whoever's running the day-to-day? How dependent is it? And so one of the first questions that we ask during due diligence is, if you disappear tomorrow for 30 days, tell me what happens to this, this, and this. Whether it's hiring or a customer complaint or whatever it is, we want to understand what does that look like today? And if there is even a mild hesitation to that answer, it is a light bulb or a red flag for us that we need to dive deeper and understand that more, because you didn't instantly have an answer to know what happens when a customer complaint happens and you're gone. If there's not like just an instantaneous answer, then it's not systemized. And that means we have to create the system. So your ability to step away with little to no impact in your business, in my opinion, is how I would summarize transferability.
I love that answer. I love that explanation, because I think so often, maybe, and not that this is a bad reason, but I think often we think about the aspects of transferability and systemization so that we can take those vacations, right? Like that's you're like, I just want to be able to go away for a little while, like just to make your life a little bit better so you don't have to do everything yourself. But at the end of the day, there's a very real reason why someone who's eventually acquiring your business not only wants you to be able to have vacations, it's like a necessity for them to want to acquire that business, because they're not going to, most people selling their business, they're not going to stay doing that job of everything they've been doing for the rest of their lives. Like, they're selling a business to be able to enjoy the exit and either retire or do something else or whatever. So getting yourself ready for that moment by extracting yourself from doing everything. And I think
exactly.
I think as business owners, we do tend to oftentimes think that we are the only one that can do X, Y, and Z. It may be true for X, but it's probably not true for Y and Z. Like, we can't actually be the best at everything in our business. And so sometimes you can find someone who's better at it than you, but also you mentioned that, sort of 80% of you being enough, like being good enough. I've heard people talk about, well, okay, hire 2 people that can do it, 70 or 80% as good as you, and now it's 150% of you. Like there's just like it's not exactly how that math works, but at the same time, figuring out those strategies to kind of get yourself just not quite so necessary for every day, which I think is scary to people, and it requires an investment as well. Investment in human capital, investment in technology, whatever you need for that particular business to get yourself out of it. It is a little bit scary. How do you approach that with the business owners that you kind of work with now, in trying to get them to that point? How do you walk them through those questions that I would assume a lot of them have around, well, how do I afford that? What if everything falls apart? Like that kind of, I think using your own story as an example is great, but I still think it's, at the end of the day, it's probably a scary moment to take those leaps.
It absolutely is. And it's one that I've personally been in that position before, where I thought I was the person that had to do it in order for it to be done at a high level. So I've kind of walked that path in terms of understanding, or at least recognizing, that I have that mentality. And if I'm going to go beyond my personal capability, I've got to figure out a way to at least hand portions of that, if not entirely, off. So how do I work through that process with my current clients? Is one of the first homework exercises. Yes, everyone, if you work with me, you get homework. One of the first homework exercises that I work with any entrepreneur, founder, owner is a week-long exercise where they just take a pen and paper, or on a tablet, their phone, whatever they want to record it on, and write down everything that they do every single day that they were the person that made the decision or did the thing. Whatever it is, they did the sale, they called the customer back, they approved this invoice, whatever it was, just write it down. And then we review that entire list. Sometimes it's very short, sometimes it's exceptionally long. Everybody's different. But then we hand select a handful of those things that would be the easiest things to hand off to someone else. Approving an invoice. Why are you approving the invoice? Don't you have an ARAP department? Why can't they do it? What is preventing them today from being able to do it? And what does that look like to close that gap? And we slowly but surely, traditionally, will pick between 3 and 5 things, depending on the complexity of each of those, per week. And we will actually systemize it. So you will still do it again. You're going to approve the next invoice that comes through. But when you do it, we're going to record you doing it so that we can create a playbook. We can create a training manual to hand to someone else so that they can learn how to do it the exact same way that you do it. Then we select somebody, we train them on it, we provide them the ability to do it on their own, and we have continual touch bases. And after we got into the place where they've been trained and we've handed it off to them, we move to the next thing on the list. And we just continue to work through that process until at least vast majority, if not all, of the things that were on that original list are completely gone because somebody else owns it. Very often we get to a place where we don't have someone today to hand that thing off to. I don't have an AP clerk. Okay. Is there a need? What's the cost involved in hiring someone? What else would we benefit from? And do a complete benefit analysis on, does it make sense to hire X, whatever that person may be? What else can they do? Is there other stuff on that list that we might be able to hand off to that individual and be able to make one hire that can impact 7 to 10 things on your list that frees up 15 hours of time per week for you? So now we've just freed up 60 hours a week for you that you can either take a day off, or we can apply those 60 hours to actually moving the business forward, additional revenue, new markets, whatever it may be. But if it's too expensive or we're not in the right place, then at least we have it mapped to when we get to this revenue level or to this profitability level, we need to hire this person for this role. And one of the metrics that we leverage for that is revenue per employee. So we will look at your revenue divided by the number of employees. There is such a thing as too high, and there's also such a thing as too low when you look at that particular metric. You want to be kind of in a sweet spot. And every company, every industry is completely different when you apply that logic to it. But as your revenue gets too high per employee, what tends to occur is your employees will get burnt out because they're doing so much. They're having to handle so much more. So there is a need then for there to be a hire to reduce some of that so that they can continue to perform at a high level. Otherwise, your service or your product execution is going to be diluted. And then the opposite is true. If it's too low, that means that we're not selling enough per person that we have on payroll. So we either need to figure out a way to increase that very quickly, or there's a potential possibility we might need to downsize in order to find the right optimization level. So we do apply logic behind it and the capability to have a metric that we can look both historically, current state, and where do we want to be future state to be able to track our progress towards that.
I like that. I like how the sort of mapping out the plan, even if it's not appropriate at the moment. The revenue per employee number, obviously it's going to be different per business, industry, all of that. Would it also be different per, I guess, level of employee? Or are you saying when you look at that, I don't know how granular you get with it, but like when you look at that, do you say, okay, this company has, 10 employees, but 2 of them are, part of the ownership group, 5 of them are technicians in the middle, and 5 of, the other, I guess that leaves 3 more are the office staff or something, you know what I mean? Like where certain positions in a company actually generate revenue, measurable revenue. I'm not saying that there are people that ideally you don't have people that are just providing no value to the company. But the point being, I would think it might be measured differently, or are you just looking for kind of an overall average across all the employees? How do you break that down for people?
Yeah, I love that question because the answer is the more data, the better. So we do look at holistically as the company. So whether you are a revenue generating employee or a non-revenue generating employee, we do look at holistically. Where is the company at? And we want to understand historically, where have you been? Where are you at today? And where do we, at least at this moment in time, anticipate you should be in whatever track record or growth plan that we're applying. But then we do take it down a layer to by department. Because the sales department obviously is going to generate more revenue than a payroll department, right? Mm-hmm. However, both are true. You can be overstaffed or understaffed in either one of them. And ultimately, even if it's a payroll department, they're going to generate more revenue the more employee, or they're going to have to do more tasks, the more employees that you have, which means you have more revenue in order for you to have more employees to be able to generate more revenue. So there is a correlation even on non-revenue generating roles where that metric can still be applied. It might be different from one department to the next, but if you understand where you've been, where you are, and where you want to go in reference to that, it does give you a North Star that you can continually look back on and track your progress around to understand when do I need to make the next hire, either holistically or within a particular department. And also, maybe I've overhired, I've overcorrected, and I need to figure out how do I redo that. Do I need to move someone from one department to another? Do I need to give them additional tasks so that they take stuff off of my plate and I can go generate additional revenue? Or is it maybe potentially time to downsize? And then there's a whole process that we look at to be able to determine within data sets who is the best person if we do have to make a decision for someone to exit the organization through this process, that we've done so with data and without non-data, is maybe the easiest way I want to put it, because some founders are very interested in keeping certain employees for a variety of different reasons. Yeah. Whether it's you were there a long time or you're related to my aunt or like whatever, there's a why behind some kind of emotional attachment to a lot of employees. But if you get rid of someone else because you want to keep that person, but that person is either in the wrong role or not generating the revenue that you need, you're actually going to see your metrics slide. So we want to be able to apply logic behind either hires or terminations.
Yeah, makes sense. Are you, when you're working with your clients, are you approaching this from or are they, I guess maybe it's not the same for everybody. Are they approaching it from I want to exit soon, or this is just like an overall business development and growth strategy? Maybe it's all of the above. I guess what I'm getting at is where in their business development stage should people reach out to you and connect and be think that it's going to be a good fit for your services?
I love that question. And truthfully, the answer is we get them in a variety of different places in terms of whether or not they want to exit. However, vast majority are at least thinking through the potential exit. Either they've been reached out to by an investor, they've been contacted, they thought about it, they're getting close to a retirement age, they want to be able to hand it off, but they have no one to hand it off to. Like something has occurred in which they're at least thinking through that as a potential possibility. So when we initially get either a lead or a referral or a potential client, the first thing that we do is a business evaluation on the current state of the business. So I apply all the same logics that we apply when I was with the private equity firm to state, at least from our vantage point, what your current value is as an organization. And once we understand that, I can also tell you where you're missing things in terms of we had to deduct a 1/4 of a point EBITDA multiplier because of X. And we were able to increase a 1/2 point multiplier because of Y. And I can tell you all of those different things and then be able to tell you a list of things that you could close the gap on that is very likely the next investor and the next buyer is going to look at as an increase in profit. And I can realistically provide you with a rough number. It's generally a range of around 0.2 of a point that I can give you. So 0.1 to 0.3 increase if you do this, a 0.2 to 0.4 increase if you do that. Because I can't ever get it exact because every buyer is going to be slightly different, but I can get you within a fairly close range. And you can walk out at that point and say, okay, I understand. I valued exactly what I was hoping to exit. I'm going to go try to sell. And now you also have a data set to know that a third party has looked at it and this is what you believe or they believe your business is worth. And so you can have that negotiation with some confidence at that point. Vast majority of our clients do get that list of things that they could close gaps on and increase their multipliers on. And we can help them through that process, whether it's the actual implementation of technology, the creations of playbooks, doing some kind of revenue per employee modeling for them to help them close the gap so that when it is time for them to want to go sell, they're at the highest potential multiplier for their industry, for their specific business, and they're ready to go have a strong negotiation. We also do assist through the entire due diligence process as well. If it's somebody who's already in kind of, serious levels of conversation with potential buyers so that we can help them navigate that process and understand what does a full due diligence look like from LOI to direct deposit showed up in the account and everywhere in between. What are all those stages and steps? When do you need to loop in legal? When does your accountant need to be on the call? When do all of these things need to occur? And what are likely going to be the questions that you're going to be asked through that process so that you can be prepared with a solid answer that puts the best foot forward for your business so that ultimately you can get the highest return on whatever investment is that you put into that business.
Do you have a specific size range of businesses that you like to work with?
Traditionally, we work with vast majority of our clients are between $3 and $10 million in annual revenue. We've helped companies substantially less than that and companies substantially higher than that. But traditionally, we are falling into that particular kind of revenue style simply because those are the ones in which you probably do have some level of infrastructure and leadership, but you're not like kind of corporate enterprise level where you have 15 different people in every single department. And so more often than not, the need for our particular type of service falls into a company that is within that annual revenue range.
Okay, great. Well, Joe, I'm going to switch gears so I get the chance to ask you the questions I ask every guest. And the first one is, basically the name of the show being Know Your Why. So what is your why? What's you've had multiple successful exits, so could probably just sit back and relax. But kind of what keeps you motivated at this point?
My why is, as simplistically as I can put it, is I want to be able to leave a legacy. And a legacy means different things to different people. But to me, a legacy is when I'm gone, when my day comes, I have made someone else, if not multiple someone else's life better as a result of their interaction with me. And that is literally why we created this company, why we do what we do, and what gets me excited to go work with my clients every single day is I get the capability to actually fulfill what I want my legacy to be. So that's my why.
Love it. I love it. When people hear this and they want to connect with you, whether that's just to connect or maybe want your services, what's the best way for them to reach out to you?
We're on every social channel out there, so feel free to look us up. Probably the fastest way to get a hold of us would be to go to our website, which is twinflametx.com. You can schedule a no-cost consultation where we can talk through whatever's going on in your world. What's happening with your business? Did you have some kind of investor reach out already, or you just want to retire one day? We can talk through what's going on, and if there is a way that we can help, we'll share that with you. If there's a way we can't really help, at a bare minimum, I'll be able to provide you with some additional insights and refer you to people who I think could be a benefit to you. But fastest way, our website, click a button, schedule a free call.
Great. We'll get that in the show notes so people can find you easily. Joe, this is great. Thank you so much for being on the show and sharing everything that you did. I think these are, it's so easy. I mean, as a business owner, I know firsthand, it's very easy to just get caught in that, sort of grind, the being deep in the weeds and just trying to get, there's enough money coming in. You're like, I don't really have to think about these things. But when you really start to sit down and think about it, there are a lot of ways, I think, to make our lives easier and particularly on the exit strategy, just getting things in place for that as well. So I appreciate everything that you shared. Really enjoyed the conversation, so thank you very much.
Thank you, Jason. Again, I was looking forward to this particular call for a while now, so I sincerely appreciate you letting me come on and speak to yourself and your audience. Thank you.
That's great. And folks listening, make sure you connect with Joe. Please rate, and review the show so we can continue to get great guests. And as always, thank you very much for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?